So we all know that financial markets, and in particular equity markets, don't develop everywhere in the world to the same extent. We know that the US or the UK have very large equity markets, and other countries have much smaller equity markets. And my research addresses one of the reasons why we see those differences in the size and the vibrancy, the dynamism of equity markets, which is the extent to which the interests of minority shareholders are protected. The argument is that when you have strong protections for the interests of minority shareholders, then more people are willing to invest money in the stock market. And as a result, what you get is a larger stock market with more turnover and higher capitalization and more dynamism. So what we did in this research is we coded the legislation existing in different countries since 1970 all the way to the present. And we looked for legal provisions that protect the interests of minority shareholders. And what we found was that at the beginning, back in the 1970s, the US and the UK and other countries that have a common law legal system have in place very strong protections for minority shareholders. But then beginning in the 1990s, and especially over the last 15 years, countries in Eastern Europe, countries in Asia, even some countries in Africa that used to have very, very weak protections of minority shareholders changed their legislation, and they introduced actually quite strong protections, in some cases stronger than those present in the United States or the UK. So in addition to finding that countries that didn't used to have strong legal protections now have them, we also found that adopting the legal provisions defending the minority shareholders is not enough, that you also need to enforce those kinds of regulations protecting minority shareholders. And that is a very important finding because essentially it means that, a lot of countries out there introduce these reforms for show, only for show, as window dressing. But it's also important to follow up with enforcement. Otherwise, you don't get the expected results, which is, the growth of a stock market capitalization and a more dynamic equity market. For me, the biggest surprise coming out of this research project was what happened in Eastern Europe and the former Soviet republics, also including Russia itself. Because as you know, most of these countries became independent in the 1990s, so they didn't have their own separate corporate legislation. And they were very aggressive in terms of introducing very advanced laws that protected minority shareholders. And my assumption going in was that in these countries, actually, the effects wouldn't be that great in terms of stock market development, because I thought they were just adopting these things, for fun. They were just adopting these things to tell the IMF that, yes, they were introducing reforms. They were adding all of these new legal provisions just because they felt that it was the right thing to do. So I was surprised to see that even within that set of countries, right? We're talking about maybe 20 or 25 countries in Eastern Europe and, the former Soviet republics, you observe that the implementation of these laws has resulted in the growth of the stock market, which is something that I don't think most people would have expected, and I certainly was not expecting. Well, I think my research has implications for both practitioners, especially investors, and for policymakers. So let's start with investors. For investors, we all know that the world has become one big marketplace, and essentially capital is chasing the best returns. But obviously, you also need to take into consideration the legal framework. It's not the same to invest in the US equity market as it is to invest, let's say, in the Nigerian equity market or in the Chinese equity market. And that's for a variety of reasons. What my research does is it calls the attention to the importance of legal institutions. Because at the end of the day, portfolio investors, they want to be protected. They want to be able to sue. They want to be able to have legal mechanisms at their disposal if they believe that they've been taken for a ride. That's the implication for investors. I offer them a map. And in fact, anyone can download the data that we have put together painstakingly for more than 70 countries between 1970 and the present time. And those data are available from my website at the Wharton School. Now, for policymakers, I think the lesson is also clear, which is that it does pay to introduce market-oriented reforms in the form of legal institutions that support economic exchange and support investment. And at the present time, as we all know, governments around the world are competing against one another to attract investment. So it is very, very important for governments to realize that they need to have the right legal framework in place, because ultimately the development of their equity markets depends on the extent to which the protections of for minority investors are in place, and also the extent to which they are actually enforced. Well, I think the conventional wisdom is that there are safe markets in the world in which it is, okay to invest, and that you're likely not to lose your money for some, strange reason, other than that maybe, the market goes south, right? Meaning that it's very difficult for either the government or other interests to expropriate investors, right? Which happens in many parts of the world. I think that conventional wisdom is largely true. That is to say, yes, you can classify countries, right, according to how easy it is for you to protect your rights as a minority investor. What my research, I think, does is it addresses this myth that, whatever the situation was back 30 years ago continues to be the same today. That is to say, what we observe is that laws and regulations concerning minority shareholders change all the time. And countries that used to have very low protections today actually have very strong protections in place. And so it's very important for investors and for the general public, I think, to understand those legal frameworks, because otherwise you could be making big mistakes as to exactly how you allocate your investments. And let's not forget that most of us have a pension fund, right? And we can make choices about how we allocate, the money that we have in it. Let's say between U.S. equities and foreign equities, and then within foreign equities, different parts of the world. So I think it's really important for us as citizens who have a pension fund to also understand these dynamics and how legal institutions affect or potentially can affect the returns to our investments. What I think is unique about our research is how comprehensive the data are. So we have hired more than 50 experts, legal experts, lawyers from different countries who speak the language, and they read the relevant legislation over a period of 45 years since 1970, and they coded all of these different legal provisions. So it is the detail that we have in our data. It is the fact that we've covered nearly 80 countries, more than 70 countries, over 45 years, that I think is unique about our research. And the data can be downloaded for free from my own website within the Wharton School's website. Well, now that we have this data on minority shareholder protections around the world, we are planning to examine what happens after a major financial crisis, such as, for example, the one that took place in 2008. As we know, there's a lot of restructuring. There's many mergers and acquisitions. And what we want to understand is whether the way in which crises are resolved, in which assets are restructured, is different depending on the strength of different stakeholders in the firm. And one very important stakeholder, of course, is minority shareholders. And so we are expecting that the ways in which crises unfold and ultimately are resolved are different depending on whether you're talking about a country that has very strong protection of minority shareholders versus another in which those protections are very weak.